Hello, YouTube. The stock market's putting in an M, which usually means more downside. But do we buy fear or do we sell fear? We're going to look at that in a few minutes because we're here into extreme fear. The market is very red over the last week. No surprise. If you looked at your account, you're like, yep, I didn't need you to tell me. I know my account's red. And 30 years of history tells us that when we go 1, 2, 3, 4, or in the month of September, and 1, 2, 3, and we're already quite red so far this month. We usually close the month of September out at the low as well, but normally we go up too. So the bears are really flexing, and we've had the worst day since March. That was yesterday. Oh my goodness. We're going to look forward to core PCE coming in on Friday, which is going to be the big number for me. And we get the big man Jerome Powell actually talking tomorrow as well. Why does all this matter? Well, it matters because I want to know whether or not Jerome is a friend or a foe. Is he going to be Dr. Doom when he takes those glasses off? Or is he going to say, you know what? We're still friends. Let's do it. Let's go up. And I say that because as we're set to close the quarter out on Friday, GDP is coming in really strong. It's at 4.9%. And this PCE number would be the first time we're actually seeing a reading that's going to be below 4%. The last time we saw that, we have to go all the way back to 2021. So if you remember when PCE fell below that key number, the market rallied. But the Fed cares more about, CPI. The Fed cares about PCE and not what CPI is doing. And if we think about this, if we go from 4.2 to 3.9, that is a reduction. Let's actually remove the stuff now. So what that would be is that would be a reduction of 0.3%. Why does this matter? Because we know the Fed has told us that restrictive Fed policy is going to be the current rate of the Fed plus 1.5%. So we're currently at 5.3, which would mean that at 4%, the Fed is almost sufficiently restrictive. So if inflation comes down by 0.3%, that's basically the same thing in terms of how restrictive the Fed monetary policy is, as the same thing as raising one more time this year by what? 0.25%. So right now we're pricing in another hike of 0.25%, and that's it. Then we're done after that. But the inflation's actually come down. So I believe, again, I believe, not I know, I think it's going to be bullish. And the reason why I think it's going to be bullish is because the Fed has jacked rates up so high, so fast. And now we note that things like the 10-year Treasury note continue to break higher. So yes, we're on weekly support here. But if we zoom out to monthly charts, oh my goodness, this does not look good. So on Friday, we went through on the stream and we talked about how we were rejecting at 433. Well, now this week, we only made it to 432 on Monday, and then we damped, right? We went lower. We dumped. So that was not good. We did not hold the low like I was expecting here on the monthly chart for SPX. So 1, 2, 3, 4, 5. That was we're going to go to new all-time high pattern. Well, as of right now, we're not holding number 4. So is history going to be close enough or we still repeat? I'm not sure, but we're not going to go to new all-time highs if we can't hold the low and make a higher high. All right, I'm going to ask you for a huge favor. If you could please consider smashing that thumbs up and subscribing to the channel, I would really, really, really appreciate that. Thank you ahead of time. All right, let me make sure I get rid of that banner. There we go. And I know I ask every day, but I really do appreciate that you guys come back and choose to watch these videos because it really means a lot to me. So thanks ahead of time. If we look here to QQQ, here QQQ is doing exactly what I want S&P to do. But man, TikTok, we're getting close to the end of the week, which means the end of the month, which means maybe we're not going to get the failed breakdown like we're seeing here on QQQ. Last one slow. 35471. We're above it by about a point right now. Was it going to hold? Man, I have no idea. It doesn't look strong, but as of right now, that is a failed breakdown. The S&P has to repeat that too. What does that mean? Man, we got to rally up like 2% in 3 days. We can do it, but that's asking for a lot here. We got to get back up to 433, basically 434. We have to rally up by almost 2% in 3 days. Do you think we can do that? Well, we're in extreme fear, which means the objects in motion are staying in motion. And right now that's down. Everything's red. So we're gonna have to have some kind of catalyst. Otherwise, history 30 years tells us that if it starts getting red and redder, it could be a bloodbath going into the end of the month. We're only down by about -5 right now. Look, a small, bigger, biggest. Small, bigger, bigger. Oh my goodness. Can we go down -10? We could, yes. And right now we're only down by about 5.5, which means we could double the loss right now. We could go down to 400 if we're going to repeat this pattern. So I'll come back and explain exactly why I'm bullish on this in a moment. But before we do that, let's just wrap up with all this stuff. When you hear the worst day since, do you know what that means? it usually means that we're going to have some of the best days since following that. The stat is that if you stay out of the market for the 2 best days of the year, just 2, right? 2 days, you miss out on more than half of the returns, period, full stop. Why? Because the biggest declines usually follow some of the biggest returns. So even though this looks really scary for September, do things change into November? Well, according to our seasonality chart, let me see if I can pull that up here. It's boomtowns, baby. Whoop, right? That's a Santa Claus rally. Down and then up, 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 up. That's the easiest, most frictionless part of the year in a normal market. So that's what we want to find out. Is this market normal? Is Jerome Powell our friend? Is he going to come in and hurt us? Well, man, thought he was my friend, right? I thought. And he's like, I don't know. Let me scratch my head and see exactly what I think. I got a cool picture of him in a second. Let me just see if I can pull it up. Where is it now? Is it this one here? All right, one second. I just got a picture of Jerome I want to show you here. So I want to see whether or not this guy, when he takes his glasses off. Come on, Jerome, where are you? Here we go. So he's like, wait a second here. Wait. I'm your friend, right? I want him to be my friend. I hope he's my friend. And I'm just not sure. If we look here to what Fed policy is currently telling us, it tells us that they're currently in a paradox. Too slow growth threatens inflation fight. Ugh, right? Double-edged sword. What's that called? It's called stagflation. It's not good. It's not good at all. So the reason why this is not good is because it just means that the Fed's like really in a tough spot right now. So what I mentioned earlier, I think I said it on this video, is that let me actually go through and re-explain it now. So if we look here to what this tells us, again, we'll come back and look at this at the end of the video. I just want to make sure I don't forget this one point here. So if we look to the PCE going from 4.2 down to 3.9, that is the equivalent of the Fed hiking one more time in terms of the restrictive monetary policy. I also want to remind you what Jerome Powell told us in regards to what restrictive actually means. It means whatever the core PCE, so if that's 3.9, and then we want to add on 1.5%, 1.6%. So if we go to the calculator here, we go 3.9 plus 1.5, that equals 5.4. Okay, why does that matter? Well, it matters because the Fed funds rate right now is at 5.33. What does that mean? If we come in at 3.9 on Friday, that would mean that the Fed is actually finally at sufficiently restrictive, according to the core PCE number. And this really matters because there's a second number that comes out on Friday, and that's going to be the month over month. So if the month over month here, and I did the research, I shared this with our group over the weekend. You can join us for 14 free days by going to thealgo.com if you want to trade with me. But anyways, we can note here that we got a high, lower high, lower high, lower high. And on the year over year, high, lower high, lower high, lower high. Well, this would be a lower low because we're going back below 4, number not seen going back to 2021. And this matters because if we look at that 0.2, if we go back 12 candles, what it means is that we're currently removing the 0.5, which means we're going back to, sorry, let me double check here. Here we go. This month right here. So we're removing a 0.5 and adding on an expectation of 0.2. That's how we're actually reducing by 0.3. If I'm confusing you, all it means is that 0.5 is bad. That's compounding at 6%. And 0.2 compounds at about 0.25% annualized, which means on this graph. So if we're removing the September one to make it 3.9, and if we're going to remove another 0.5 next month, what does that mean? Well, we could get another reduction of 0.3 or the equivalent of another Fed hike. What would that mean? Man, now the Fed's actually restrictive. They're restrictive by almost 2%. That's a lot. And that's what their dot plot said. So if that's everything that we look at here, and Jerome Powell talks tomorrow, or he talks tomorrow at 4 o'clock, but then before we can trade in the cash market or from 9:30, we get core PCE. So you have to make sure you really understand what this stuff means. Look at Europe as well, expecting to come back down here to 4% inflation. That's looking pretty constructive. Why? Because around the world, we want to see this too. So what this means is that I could see that, again, if we get 0.2 and we get another 0.2, a lot of ifs, a lot of maybes. All I'm trying to tell you is that this is my working theory right now. When we delete these two 0.5s, and if we add 0.2s, it means we're going to see this number come down just like we did with CPI. We're going to go down to 3.9, then we likely go down to 3.6. We look at charts all day. So if we go high, lower high, lower high, low, lower low, lower low, and another lower high and low, isn't that bullish? I think so. And then that would mean that the Fed could say that we're ready, willing, able, blah, blah, blah. We're going to hike more. But if inflation comes down, they don't have to do it. The market's going to price out that expectation one more time. And why does this matter? Well, it matters because when we go to that Fed watch tool, we know when we're expecting a hike. And right now, cuts. So right now, it's a 77% chance they're going to hold flat at the next meeting. Before, it was over 80. I think we have to go to June or July to see when we actually see that that cut. So pause all the way into July. Now we got the cut in July. It's only by about 5% though. So the Fed's like, they're winning. They're getting what they want. And this could do a 180. I could be totally wrong too. And here's where I'm going to be wrong. If we look here at monthly charts, again, the S&P, it's a breakdown. QQQ, as of this second, it's currently a failed breakdown, but man, it doesn't look good. It's definitely a cup and handle, but it's not looking so good. The dollar's up by 3%. Ouch. We note that the VIX is up by 34%. The 2-year note up by 5.5. We look over here to the 10-year note, and we're looking at a monthly chart to smooth the data out. So 12% for the 10-year note. Oh my goodness. This is not good at all because it's breaking out. It's giving us that crash signal. And what's the market doing? Baby, it's crashing. It's not looking nice at all. And then finally, if we look at one more indicator here, these are stocks that are above or below their 50 DMA and 200 DMA. Ugh, right? This looks terrible. Only 13.7% of stocks, or 14 out of 100, are above it. And this is a reading as of yesterday. We got a decline of 30% on the 50 DMA. On the 200 DMA, woof, right? We're at 39%. And this reading will be updated as of tomorrow. So we'll get today's reading tomorrow. So if we look at this and we ask ourselves, okay, so if it's not like June where we basically go to zero, well, this is like where we formed the bottom, isn't it? It kind of was. Yep. And then the market went straight back up. So this means like we're definitely oversold here, right? Only 1 in 10 stocks is above their 50 DMA or the short-term price. As we've been going through and looking at our buffer below 50 DMA, it's not just the S&P, it's the whole universe of stocks that matter. We've gone from the 50 nearly to the 200, got a gap fill. I'm not sure. Let's look through these stocks now. So QQQ, below. SMH, below. NVIDIA, below. Apple, below. Tesla, below. FXI, below. Microsoft, below. ARK, below. Below both. DAX, below the 50 and 200. Yuck. XIU or Canada, Death Cross, we're below both, a 50 and 200. We're looking at the blue line here. Yuck. That chart looked not nice. Emerging markets, Death Cross forming, and we're below both averages as well. Nikkei, below. Ethereum, below. Bitcoin tagged the 50 DMA today and rejected below. There's not a single chart that matters that is currently above its short-term price. So it's no surprise that we're seeing that most stocks are below their 50 DMA. All right, so now let's go through and provide a little bit of optimism, because if we're going to buy the fear, what are we looking for? Well, we're looking specifically for this number to come in as expected, if not better. And this is the catalyst for the bulls. Otherwise, the bears are currently winning. We're on support. They could drill it lower. They could definitely win more. Why? Well, why not? That's what we want to think about. So if we go further now, I want to talk about what happens in October. Why? Because it's so scary, right? Oh, spooky, spooky, spooky. So what I want to do right now, and I didn't actually prepare this ahead of recording, so I want to go through this right now and see whether or not we can understand together what happens if we're looking here at 2020, 2021, 2022, what happens into the next month. Why? Because everyone's so bearish now, right? Everybody's bearish. I was bearish going into the start of the month, but I said if I'm going to trade one side of the tape, I want to trade it bullish. So leave me a comment. I'm actually really curious. You can leave me a number 1 if you're bull, or leave me a number 2 if you're bear. I want to see if people are actually watching till the end of the video too. So if you're bullish, type in number 1 in the comment section. If you're bearish, type in number 2. I'm expecting a lot of 2. So show up, bulls. Prove me wrong. All right. So if we go back here, let's get my lines back. Let's just go through here. So what we want to compare, and I didn't do the period back here. I'll try to do that too if we have some time. So we're going to look at October of 2020, 2021, and 2022. Why? Because if everyone's so gung-ho on September, well, what happens next month? All right, let's go back in time here. So September, oh man, that's like a pretty good month right here. Terrible month in September, followed by what? A nice failed breakdown. We move higher, and then we go to where we are now. So this candle right here looks pretty nice. That is October of 2022. Okay, let's go to October. Oh, what is this? Another failed break. Oh, yes, right? That's a big month. Whoa. Okay. Let's go back to before now. There's the red one. There's the one for the bears. So we got an inside bar here, and that's a red one. Now let's see what the average gain is if we look at all of them. So we're going to go here from the close to the high. We got 7%. Let's just tag that here. Let's go 7 for the first one. So we're going to do a little bit of math here too. I'm doing this with you, so hopefully you appreciate it. From the close to the high, the close to the close, 8.5%. So now we got 8.5. Not bad, right? Yeah, 7%, 8.5%. What would that be for us? From right here, that would be going back to new 52-week highs, back to 460. Would you believe that? I don't think people will. So cool, let's do it. Let's go up. And then for the month here, we went down by about 3%. So we got -3. So now we're going to pull out that trusty calculator and we're going to find out what the average is here. 7 plus 8.5 minus 3 divided by 3 equals an average of 4.4%. So if we rally 4.4% and we close the month out here, that would basically get us back up here to 445. That's not so bad. I think people would be a lot less bearish at 445 than where we are right now. Cool. So it's like 2 out of 3 times. And we didn't really have the terrible month here. It's bad, but it's not like terrible. In 2021 and 2022, it was terrible. And remember, the seasonality chart says we get a failed break into October, which is exactly what we got here. So we got a failed break here because we got a lower low, but then we actually get a failed breakdown in a bullish engulfing candle. That leads to the blow off top in the all-time high. And then here for the same month in October, we have a lower low, but we close above it, which means failed breakdown. So maybe I'm just wrong about what I'm looking for. I'm looking for the failed breakdown. I thought it was going to happen last month, not this one. Hey, is it still close enough that it's going to play out? I don't know. So again, I say I don't know a lot because it just means I just don't know. I don't want to pretend like I know everything. Now I just want to go back in time here to look at the worst period. So we're going to look at 08 and 2011 next. Hopefully you're enjoying this too. Let's go to 08. So here we got September. So green and green, we're going to discount that because we want to see a red September. I don't know what's going on here. 2008. Oh, I'm looking at 2007. Oopsies. Yeah, this is a bad one. Oh, geez. All right. So we go down by -10. And then by the end of October, we're down by -35. Please don't be 2008. I hope it's not. Oh, that would be bad. Okay. Now let's look at 2011. All right. So if we're red on the month and we perform another monthly lower low, then that's bad. In 2011 here, we got September and October. Oh, yes. We got a bullish engulfing candle. So here we note we got a bullish engulfing candle. That's a pretty nice bar too. So October was a low. Santa Claus rally into the end of the year. So if we're like above the previous monthly low, that's good. If we're below it, terrible. So we want to make sure that we're closing out below it. All right, let's look at the last ones here. We're looking at 99, 2000, 2001, 2002. Let's see what we got here. So we're going to go to 2002 first, and we're just going to look here to September. A terrible September. And what? A beautiful October. Failed breakdown. And we're looking at the candles right here. So we're looking at, this is September, the red one, and then the October is going to be the green one. Not a bad month. Failed breakdown. Beautiful. Let's do it. If you look here to, there we go. There's September. There's October. It's not a great month, but we got October, November, December, all green. Santa Claus rally, inside bar. We don't break the low. Cool. Even in a bear market, right? October is like pretty reliable. Let's look here now too. So we got September, October. So we go low. We actually do reclaim it into the close here. Close at 144. Low is 142. So we're looking here at September and October again. And this one here, not quite as reliable. So we know that if we're below, that's bad. So now I want to go back in time and see whether or not the notes that I've laid out are actually good or bad. Come on, bring my lines back here. Why? I'm looking for that failed breakdown. And it's a very, very, very important pattern for me. If it holds, it's great. It's bullish. If it does not, it's not bullish. So if we cannot reclaim the low at 433 or go up 2% into the end of the month like QQQ is right now, I need to see this low hold, the 440 to 422, or if we go below it, I'm not bullish if we're below it, just like I'm not bullish if we're currently below 433. So I think that provides a lot of insight. And now if you want to see the big bad bear case, that video is now queued up here on the left-hand side. And if not, thank you so much for tuning in. And if you want to come trade with me, Justin from YouTube, there is a link in the description. If you want to come join us, thank you so much for tuning in. I look forward to seeing you tomorrow.